Good morning. Welcome to the last webinar of 2021. I can't believe the year is nearly over and it's ending with a bang. Global markets are up between 20% and 30%. You really couldn't go wrong this year, which was fantastic for investors. Next year is not going to be as easy, but we'll go through our views on that later on. We were very excited to launch our China fund last month in November. Sygnia is one of two. There are only two managers in South Africa that are licensed to trade mainland China, Sygnia and one other. We're very excited about the fund. You'll have to wait until February next year for the full webinar, but I've got a quick summary here for you as the fund is available and you can invest in it now if you would like to. So why invest in China? The short answer is that the Chinese economy is 1.2 times the size of the US. It's the largest economy in the world on a purchasing power parity basis. But it does not even appear in the MSCI World Index, while the US makes up 70% of that index. It's a bit like the World Series of baseball. It's all about the US and the rest of the world just doesn't exist. So it's good to balance your investment strategy with or at least the size of the economies that exist out there. If you're sitting in the US, I can understand why you don't want to look beyond your borders. But in South Africa, we're used to volatility. We understand emerging markets. It's not a stranger to us, and it's good to balance your portfolio across the globe. But I do acknowledge that China is a volatile and at times very risky market because of the centrally controlled government and the way that decisions are implemented sometimes overnight. And that's why this fund is specifically designed to align the underlying investments with China's strategic growth path, their common prosperity plan. At the moment, it's their 14th five-year plan. They're made in China 2025. So that means investing in consumption upgrade, healthcare, technology, renewables, and high-end manufacturing in particular, robotics, 3D printing, and the like. So in a way, it's the Chinese version of the Fourth Industrial Revolution Fund. It's not quite the same because you don't have the same access to data, but that's certainly what we're going for. And it also provides investors with access to China's mainland or onshore or A-share market, which is currently capped at 30% to foreign investors. But as that cap is lifted, so there'll be more and more flows into that segment of the market. And to be an early investor and be ahead of those flows is certainly something that is quite exciting. So along with this fund, in November, we also launched our first 3 dollar-based funds based in Ireland. We launched a global income fund in dollars, a dollar version of our health innovation unit trust, and a dollar version of our Fourth Industrial Revolution Fund. So those up and running, and you can invest in them as of now. We're also trying to expand that universe. So hopefully within the next 3 months, we'll also have included this China fund in Ireland, as well as our new sustainable technology fund, which is on its way in ETF format in South Africa, and will soon be in the dollar-based version will soon be available in Ireland. So lots of exciting things happening, lots of new funds, lots of new ways to access our existing funds. So at least there's going to be a lot more opportunity to invest for our investors next year. And we think you'll need it because next year it looks like it's going to be a tough year. Valuations are looking pretty stretched. We're getting to the end of our growth runway, and you need to be quite specific about where you do invest. But before I'm getting ahead of myself, before we look at next year, let's look at November. So November in review. It was certainly the Grinch that stole the positive returns. It was, as you can see there, most of the world was in red. Commodities were down, markets were down, developed markets were down, emerging markets were down. The only safe place that existed in November was being long dollars. The rand depreciated significantly, and then being invested in dollar bonds. And you can see those three at the bottom there, your only source of safe haven. Gold, once again, was not a safe haven. Bitcoin, once again, was not a safe haven. Just really dollar cash and dollar bonds worked for you. But what was interesting is in November, it resurfaced the K-shaped recovery. I've been investing in markets for over 20 years. And I know about the L-shaped recovery, which is generally what South Africa has. We fall and we just never recover. I know about the V-shaped recovery, which is what the US does. It falls quickly and recovers very quickly. I know about the U-shaped recovery, which is generally what happens in Europe and Japan. You know, they fall less slowly, but they recover. So they fall more slowly, but they recover more slowly. But there's now the K-shaped recovery, which is fantastic. And you have to initially I was, what on earth is a K-shaped recovery? But that talks about COVID winners and COVID losers. So on last Friday, when we had the Omicron announcement, we had financials in South Africa down 10% on the day. I mean, there was just a massive fall. And Naspers, being one of our best COVID winners, was up on the day, up 2%. So the K-shaped recovery, something we haven't seen for quite some time, resurfaced in November along with Omicron fears. Fortunately, it doesn't look like Omicron is going to be the next Delta variant. It's still too early to tell. And certainly that's one of the biggest risks that could exist in 2022, is if Omicron becomes the next Delta variant or worse. But Fauci says that looking at the data, and again, he says it's too soon to say, but looking at the data is encouraging. So yes, the Omicron is highly contagious and spreads much faster than the Delta variant, but it's also a lot less severe. So it could get to the point where this, if we follow the Spanish flu cycle, where there were 4 waves and it lasted about 2 years, this could be the end of COVID. If we have a variant that is so contagious that it blocks out all other variants, but is not severe and ends up being only as severe as influenza, well, then we're back to a world as normal. Now, I doubt we'll be that lucky and things will be as good as that, but that's certainly what happened in history, and that would be data can still support that outlook. Of course, it could be that Omicron becomes or is actually more severe than we currently appears. And although hospitalization rates are pretty much flat in South Africa and flat in the UK, and even those that do go into hospital are staying much shorter than before, well, things could still change. So it is one of the big risks, but it's an upside risk as well as a downside risk. And markets certainly last week or November in particular only priced in the downside, and that seems to have recovered slightly with our market now making new highs. So I think markets realizing that it's too soon to decide whether this is an upside risk or a downside risk, and so it's being ignored for the moment, which I think is the right thing to do just in terms of pricing that risk. So looking past Omicron and into the underlying fundamentals that drive the world, geopolitical risk is on the rise. This is Putin's first appearance in my webinar. It's very exciting to see him here. He lends a certain gravitas to the webinar, and it's just nice to see the intensity of his face. But he's been voicing concerns about US naval exercises in the Black Sea, saying that they are leading to increasing tensions between Moscow and NATO. Yes, I'm sure that's a good excuse. Meanwhile, he's amassing over 90,000 troops at the Ukrainian border and is limiting gas supplies to Ukraine through Germany to try and encourage Germany to sign Nord Stream 2. Now, the US has certainly highlighted Russia as their current biggest threat and their current biggest enemy. Biden has threatened sanctions against the US, and he's also said that if Russia invades the Ukraine, that they will do everything they can to make sure that Nord Stream 2 doesn't go ahead. Now, that's all a bit of a contentious issue anyway. Germany did suspend the Nord Stream 2 application in November, and gas prices jumped 17% on the news. With Russia and Belarus both holding back gas deliveries, Europe needs that gas. So Putin really does have them over a barrel. But if the US steps in and this becomes a larger geopolitical issue, well, we could start to see gas prices rising and certainly a lot more saber rattling happening along the Ukraine border. So that the US is focusing pretty much now on Russia, and that certainly seems to be a big risk, and it is a big risk to energy prices for Europe going forward. On the other hand, Biden doesn't want too many enemies at once. So he's actually being a lot more friendly to China than markets were expecting. So Biden and Xi Jinping had a productive summit, much longer and much more productive summit than people were expecting in November. And Biden came out to say that he supports the Chinese political system and confirms that the US does not support Taiwanese independence at all, which is consistent with what they've been saying for the last 20 years, but they haven't ever been as vocal about it as Biden was during the summit. So that's very interesting. And that while Russia provides a downside risk, China and the US working more closely together, that provides an upside risk. And certainly Chinese earnings and US earnings could go substantially further up if the tariffs are reduced. So we're now watching both that US-Russia tension and the US-China tension to see if there are upside or downside risks to 2022. Meanwhile, the world was a bit concerned about COVID anyway before Omicron arrived, with quite a strong fourth wave going through Europe and causing increased lockdowns and reduced mobilities, which was a bit concerning. But at the same time, again, that was a downside risk. Asia growth has bounced back as mobility has increased in China and Asia as they move through their fourth wave. So again, balanced risks there as well. But the most important thing for markets really is just the amount of money that's out there. When it comes to fighting central banks, you can't. The size of quantitative easing is just so huge that as long as monetary policy and fiscal policy are supportive, you really can't expect a recession, and you can't fight markets in their upward trend. And the chart here, and it's the most important takeaway from this slide at least, just shows that despite everything that's happening, despite tapering and recalibration, as Europe is calling it, quantitative easing will continue in 2022. So the orange line shows the flow. So yes, bonds will be bought at a reduced rate, but the central banks will still be buying bonds. They're just buying less bonds than this year. So that if you look at the stock of bonds on central bank balance sheets, it's the blue line, that's still going up. So we are still in a QE phase, even if there's a much more reduced phase. So there's still strong monetary policy support, and fiscal policy, although it is also coming off its highs, is still positive into 2022. So we remain positive on growth into 2022. There are upside risks, there are downside risks. One of the big issues is valuations. Valuations are certainly priced in a lot of upside. And that is our big concern for 2022, and why we think that growth returns will certainly be a lot more differentiated than they were. But overall, we're not expecting recession. We're not expecting markets to give major losses. We are just expecting some volatility, and equity still to be the best place to be in 2022. Just need to pick which equity market is going to perform best. So looking to the US, we did see some positive news out of the US. President Joe Biden renominated Jeremy Powell for a second term, and that's good. Powell has been around, he knows what's happening. Consistency is always good for markets, even if it's bad consistency. Markets don't like uncertainty, they like to know what's happening. Everyone knows Powell, they know his hymn book, and so we're going to be sticking to that play, and we're very comfortable that is what is going to happen going forward. And that certainly also provides some protection to the markets in 2022. So one of the other reasons that we did have a wobble in November was not just Omicron, there was also concerns that inflation is out of control and the Fed is behind the curve and they're going to be forced to raise rates very quickly. But we remain of the view that that is not a risk to markets in 2022. Yes, headline inflation rose in the US at 6.2%, higher than South Africa's. I mean, I can't. There hasn't been a time in history that South Africa's inflation has been lower than US. It's certainly something that is quite a change. And the JOLTS survey shows that America is now at a new high for Americans quitting their jobs, which also implies wage growth pressure. So on the surface, inflation looks like it's getting out of control in the US, but we remain on track with our hymn book that inflation is transitory, even if it is more transitory than that everyone thought. But supply bottlenecks are easing. The Baltic dry shipping rates have halved, and that's very, very important. So that's going to be a tailwind to inflation coming through. US natural gas prices have also halved. That's again a tailwind to inflation, coming off a very high base. And yes, rents and other food are going to continue to rise in the US, which will be cause inflation to go up. But when you've got this strong tailwind from falling natural gas prices and falling shipping rates, well, that should keep inflation well controlled. And certainly long-term inflation expectations in the US are anchored and within the Fed's range. More importantly, looking at the chart on the right, the Fed has a dual mandate. Not explicitly, but they're targeting employment as well as inflation. And if you look at the chart on the right, employment is not back to its pre-COVID levels. So even if inflation is currently above the 2% level, the Fed is going to watch labor participation a lot more closely, and that'll give them some headwind, some freeway to allow them to just be behind the curve when it comes to raising rates. Similarly, the US Michigan Consumer Sentiment Survey fell to a decade low of 66.8, down from 101. So right now, the US consumer is fragile. They're worried about inflation, they're worried about COVID, and if the Fed raises rates too soon, they know they could cause a recession and could destabilize the already fragile consumer. So we think that although tapering might be accelerated slightly, that the first hike is still on track for only September next year out of the US. That said, while we think that the Fed will be patient and the Fed is not going to cause a recession, we do think that the dollar will weaken because the Fed is behind the curve. We are concerned about valuations in the US, and as a result, we are underweight the US and overweight other developed markets, Japan and Europe in particular, as we think that rest of the world growth will catch up to US growth in 2022. And we think the returns from those markets are certainly more attractive going forward than last year. So looking at the other or the biggest economy in the world on a PPP basis, China continues its common prosperity narrative, but things are starting to look up in China, even if markets are still trailing along their lows. So we had a lot of very positive data come out in November, looking at the October numbers in China. Growth certainly seems to be stabilizing, which is very positive. And while DiDi has been forced to delist in the US, or they will, China is expected to resume gaming registrations, and they certainly are talking about easing up on the regulations. And at the same time, they announced a 50 basis point cut in the reserve rate requirement that will happen on the 15th of December. So China is starting to realize that markets have fallen a bit too far, and they need to protect growth, they need to protect employment, and they're starting to sound more dovish. And while it's very much targeted, they aren't going to allow Evergrande to cause any systemic impacts. And it looks like policy support is starting to turn in a favorable direction for China. So that certainly does support our overweight China view and our overweight emerging market views. The other positive reason for staying overweight emerging markets and China is the COVID vaccination rates, which are finally converging. So the top right-hand chart there shows at the top, Euro area, 70% vaccination, the US at 60%, and LATAM and EM Asia catching up to those nicely, which, as I already said, mobility has started to increase in China and Asia as a result of those vaccination rates converging. Yes, they're behind the curve, but now they've got a chance to catch up. So while growth has been a little bit low and disappointing out of the Asia region, that should catch up in the first half of 2022, supports our overweight position there. At the same time, valuations are looking incredibly attractive. The bottom right chart there shows the emerging market index against the US. Now, what is fascinating about this is that emerging markets are now at 15-year or all-time low against the US. And that is despite all the risks that we've had in the past. So 2008, you can see here the first major dip. That was the great financial crisis, the housing subprime crisis in the US. EM is currently cheaper against the US than that. It's quite something. 2013, the next blip there, the taper tantrum, again, EM is currently cheaper than that point. 2018 is the next big blip there. That was Trump's trade wars, which were targeting China and emerging markets. 2020 was the COVID recession and the concerns that would have impact on emerging markets without vaccines and lower trade and lower growth. And now 2021 is Chinese tech regulations, and that has actually been the worst impact on EM compared to the US, and certainly was pricing in a significant amount of risks. Now, as I've said many times, valuation is never a trigger for investing. Valuation can certainly highlight value traps, and just because something is cheap doesn't mean it's the right time to get involved. It does mean the risks are a lot less, but it doesn't mean it's the right time to pull the trigger. However, looking at the EM convergence of vaccination rates, we feel comfortable. Look at the fact that the taper risk is behind us, and particular EMs are far better positioned for taper risk than they were in 2013, with current account surpluses and much lower foreign bond ownership. Well, that's a positive. And in particular, looking at the positive signs coming out of China, we think that is a catalyst that should support China and, as a result, EM growth going into 2022. But even more important is the weak dollar that we expect to happen over 2022. When the weak dollar is weak, that is very good for emerging markets and tends to lead to times of emerging market and rest of the world developed market growth outperformance of the US. So weak dollar is one of the primary reasons for our catalyst for next year. Longer term, of course, we still love the theme. Not only is EM underweighted in the index as part of on a PPP basis, but 88% of the next billion people becoming middle class will come from the Asia region. So short term and long term, and valuation and catalyst, it all looks like a good time to be investing in emerging markets, a good time to investing in China, and it's certainly where we are invested. Now, I had a question from one of our clients on China, and just saying, now that you've got a China unit trust, does that mean you're going to sell your EM50 ETF and invest in China? We're also launching a China ETF that should be available in February next year, which is why we delayed the webinar. But we don't think that China replaces EM. The fact is, China is underrepresented in the EM basket, and the EM basket is underrepresented in the world basket. So while we believe you should keep an EM basket, we don't think that there's enough China in that. So it means you should have both. And exposure to EM, to Korea and Taiwan, which are great regions with very strong semiconductor exposure, very strong growth, GDP growth, great places to be. But China, you need to top up your China exposure, and that's what we are doing. The China exposure within the EM is about 1/3 to 40% of EM, and it's very broad exposure, whereas our unit trust has got a bit more of the new economy feel, so it's a bit more protected, or at least focused on economies that the government is supporting in their 5-year plan. So we think the two go well together. It's not a replacement. So those are our two global players, the US and China. Looking at South Africa, which makes up less than 3% of the EM basket, which makes up less than, well, nothing in the MSCI world, and around 30% of in the MSCI all country. So really insignificant in the global scheme of things, but very important to us. That can't be ignored. Our liabilities on rands, we are going to retire in South Africa, and it's important that we do have exposure to South African equities and South African bonds. It's also important that we know that when to buy and when to sell, because there is a lot of volatility in all emerging markets, including South Africa. So very, very, very good news out today is that the land expropriation bill that's without compensation failed. It needed 66% support. It only got 58% support. That has been a negative sword hanging over our necks from a foreign investor perspective for a long time, and that's now finally out of the way. So that is a very positive. At the same time, we did have a really good budget. Our finance minister delivered his first budget policy statement, and he emphasized that government has an unflinching commitment to fiscal sustainability. It was really well put. But as usual, South Africa has not been delivering and is really good at promises, and we need to make sure that those promises actually happen. So looking at the good points of the budget, debt is only going to peak at 78% now in 2020, 2025, 2026, down from 88.9%. This is partly due to strong windfall revenues due to high commodity prices. It's also partly due to GDP being revised upwards. So that's really good. Nothing that we did for ourselves. It was just I'm not going to say luck, but external reasons that our debt to GDP is much lower than expected, but that's a positive. But the risks remain. There was no allowance made for the extension of the social distress grant, effectively the COVID grant. That ends in March 2022, and there's no budget for that being extended. Similarly, there's no budget being allocated for negotiations of the 2018 wage agreement, not going through at 0%. So there are risks to the upside, and implementation risks remain. But besides the land reform, land expropriation not happening, and a decent budget, that's where the good news ends. Unfortunately, third quarter GDP fell 1.5% in South Africa, which is not good, fell more than expected. And the MPC raised rates by 25 basis points. Yes, our real rates are low, and they do need to start normalizing, but our consumer in such a fragile economy with load shedding can't afford to pay higher rates. So that is going to be a headwind, unfortunately. But most importantly, and the key factor, even if it is a lagging indicator, the key factor is unemployment. Unemployment rose to 34.9%, all-time high. Now, if you want to compare that, at the peak of the United States Great Depression in 1933, US unemployment rose to a horrific 25%. So we are now way worse than the US was in the Great Depression of 1933. And it's not surprisingly there. There was a great presentation by Sanral ahead of their new debt issuance. And they have said that they are now spending half of what they spent in 2017 in terms of building new roads. Our road conditions are now the worst they've ever been. 40% of South African roads are either poor or very poor. And yet Sanral is spending half of what they spent 3 years ago, and way below what they want to. And why? Well, for ostensibly a good reason. To try and prevent corruption, a lot of new procedures have been put in place around procurement and tenders, and that's just led to a complete freeze. Whether it's, I'm not even going to go into what the reasons are, but again, we're trying to do the right thing. We're trying to step out corruption, and all that's happening is we are losing jobs, and our roads are deteriorating, and things just aren't happening. And I think that is pretty representative of what's happening throughout SOEs in South Africa. According to the latest annual reports, several SOEs are close to total failure, including Eskom, SABC, Petro SA, Dunel, and Land Bank. And I think a lot of that is just a standstill as the old regime that's there is trying to continue with the corruption and the way that things were done. And Cyril is trying to stamp out that corruption. And as a result, we're just kind of having nothing happening. Yes, no new corruption, which is great, but at the same time, nothing's happening. Now, hopefully this resolves itself in the fact that eventually we get over this hump and things start to happen with less corruption, but that we haven't got there yet. It's a bit of a slow burn, and as a result, unemployment is reaching horrific levels. We also had ICASA again delay the spectrum allocation. And so some of the low-hanging fruit that was promised for reforms was visa reform, was ICASA and the spectrum, and these aren't happening. And now we unfortunately at peak tourism time, we've had markets or countries around the world put South Africa on the red list, which is terrible for our tourism. We're not going to see any hard currency come into South Africa over December, January, and enjoy our beautiful beaches and weather, because we have Omicron variant. And enough has been said about that, and Africa being blamed and Africa being put on the red list for a degree of reasons. So I'm also not going to talk about that. However, what does this mean? So the chart on the bottom right shows the rand over the last 2 years, and you can see the downward trend that we had in 2020. That's peaking at 19.5, going all the way down to 13.5. That green channel, as the rand strengthened on the back of strong resource prices and global tailwinds, with massive monetary policy support, with massive QE and massive fiscal support. And now you can see that we're firmly in the depreciating channel, the red channel. We're at the top end of that, so I do think the rand in the short term can come back and easily reach 1470, 1480, but we are in a weakening channel, and we no longer have the strong support of QE and fiscal. Yes, they're still positive, but so not negative, which is great, but they are a much smaller positive. And at the same time, while commodity prices will remain elevated in 2022 because of electric vehicles and supply constraints, they're not going to be as high as they were. So our tailwinds are certainly a lot less, and we think that the rand is going to be in this weakening channel for next year, and probably end the year closer to the 16 level, maybe equal to where we are right now. So strengthening down to 1480 and then trading in a 1480 to 1618 band over the 2022 year, but ending probably flat to where we are. It all depends obviously on Omicron and what that has on global lockdowns, on global trade, and impact it has on QE and the rest, as well as growth. There could be local events which improve that, but the trend has definitely changed. The tailwinds are a lot less. We still remain bullish on global growth, which is generally bullish for the rand, so that we don't see massive weakening this year. As I said, probably flat over 2022, but the time of appreciation is unfortunately behind us. That said, we're still very positive on South African bonds. There's still a lot of buffer that's been priced in, compared to 0% in Japan and the Euro area, 1% in US 10-year bonds, getting 10% in South Africa, a real return of 5%. That's just a phenomenally good return. The pricing and a lot of risk, and we feel comfortable that with the sideways moving rand, and even with the headwinds of global US yields rising, which we do think they will on continued growth, there's enough buffer in there for South African bonds to strengthen during the year. Again, probably most likely scenario is a sideways moving market, but if you end if you get to the end of the year and we are at the same yields we are now, you're going to earn 10%. We think the yields will be a little bit lower, so you'll earn 10% plus some capital gains, which will make it a phenomenal good asset class. And we are overweight South African bonds and underweight South African equities and underweight South African cash. So just a bit more on our positioning and the outlook for 2022. We keep 2 of our big trades. We went into 2021 overweight value, and that unfortunately did not work. Didn't lose us anything. We're basically back to the levels that we started at the beginning of 2021 in terms of value versus growth. And we did have a nice rally in the first half of 2021, which we gave up into at the end of 2022. But we think that, chart on the left here, the dark solid line is US bond yields, and the dotted line is value over growth. And we do believe that as growth recovers, continues to recover, yes, we haven't had some delays by Delta variant, we've had some delays now by Omicron. We do think that the growth will finally recover into 2022. Might be the last year of positive equity markets. As 2023 might lead to the Fed raising rates too quickly, but 2022, still got positive fiscal stimulus, still got positive monetary stimulus and QE. Fed's not going to raise rates in the first half. Growth will continue to recover. That will lead to bond yields rising, which is good for value over growth. At the same time, when bond yields rise, when the rest of the world, when that leads to and the Fed being behind the curve, the dollar will weaken. And a weak dollar is very good for non-US markets. So we also remain overweight non-US, both emerging markets and developed markets, Europe and Japan. So that is our catalyst, again, the dollar and rising US yields. But just looking at valuation perspective, and this is the chart on the right, and again, valuation is not a signal for, it's not a catalyst, but it is a risk indicator. And this chart shows the price to book relative to return on equity. So generally, the higher your return on equity, the more you're prepared to pay for that equity in the book. And you can see that the chart over the last 50 years has a decent correlation. So it happens on a company level. If a company is giving you a much higher return on the amount of money that you invest into that company, well, then you're prepared to pay more for that company. But we've got to a point now where the US is trading nearly double the price to book ratio that it should be. So yes, the US is a quality country. It's got the most market-friendly policies. It's got the most innovation. It's got the most creativity. It's got a phenomenal tech sector. It's got phenomenal patents and copyrights. And as a result, it is your best growth engine over the last 40 years. So you expect the price to book to be much better, much higher than other developed markets. So this is just US versus other DMs of Japan and Europe. But the price you're paying for that is nearly double what you should be paying for it. So the scarcity of growth in the rest of the world is just pushing up the valuations in the US to rather concerning levels. And that's why, again, we stay overweight value and underweight the US, and overweight in the long term our growth satellites. So why the growth satellites? Well, Japanification remains our long-term roadmap. We are still concerned about high debt levels constraining growth. We're still concerned about aging demographics constraining growth. We're concerned about QE and rising financial oppression constraining growth. And we're concerned about falling productivity constraining growth. All of those lead to lower returns and higher volatility. So just two updated charts to just looking at the US. Developed markets and EM on the top right-hand chart. So the blue line here is developed markets, gross government debt as percentage of GDP. And you can see there at 30-year highs, and emerging markets again at 30-year highs. So all the fiscal stimulus has driven government debt to all-time high levels, and that will constrain the amount of fiscal stimulus that governments can do. It will also mean the taxes have to rise, which constrains the private sector. Also, it's the crowding out of the private sector, et cetera, et cetera, et cetera. Bad for growth. Looking at the US from a demographic perspective, and this is quite concerning. So aging demographics was one of the key catalysts and headwinds to Japan, and why Japan started quantitative easing 23 years ago, because their population reached a shrinking point 20 years ago. Europe hit that nearly a decade ago, a shrinking working age population. China reached that about 5 years ago, and the US is predicted to hit that this year. That's the solid blue line. There's a small chance that if immigration is positive, and we don't know that yet because Trump had very strong anti-immigration laws, but if immigration is positive, then the US might actually eke out some positive population growth. But as I've said before, GDP is about the number of people who work and how productively they work. And if your population is not growing, you just have no support on that side in terms of GDP, and you have to rely fully on productivity. And productivity is very limited, so it means your GDP growth is constrained. South Africa, of course, the key to the whole aging population growth leading to GDP is education. So it's pointless having a great population growth and having your prime aged region growing strongly. South Africa is growing very nicely if those people aren't being educated, so they can't enter the workforce. So unfortunately, we don't have the demographic headwind. We've got a fantastic demographic tailwind, but those people are tragically not being educated, are not being looked after, are not entering the labor force, and that's why we're having this massive unemployment spike. So for different reasons, we have the downside to GDP growth, just because our working age population is shrinking, not because of demographics, but because of not being able to convert those demographics. So looking at the next decade versus the last 3 decades. And this is very much in line with our Japan Navigation Rulebook. Our numbers are slightly different, but very similar. This is a BCA forecast for the next decade versus the last 3 decades. So the bottom is the charts on the left, and you can see here, most importantly, over the last 30 years, 1990 to 2021, your balanced portfolio would have given you a real return in dollars of 6%, 6.1%. They're forecasting over the next decade a balanced portfolio to give a real return in dollars of 1%. That's just shocking. Say the rand depreciates 4%. You're looking at 5% in dollars, real in South Africa, which you're going to get if you buy South African bonds with a whole lot less volatility. So 1% real return for a balanced fund with a lot of volatility is not a great return. Yes, we can take advantage of that volatility, and we certainly do in our balanced funds, but things aren't looking that great over the next decade. And I've said it before, but the only really way out of this is to retire later and save more. They're not easy choices, but things aren't looking great. So breaking it down, US equities giving you 3.7 nominal return, that's before inflation. So that's 0.7% real. Other developed equities will give you 1.9% real. EM gives you 4% real, 4.1, which is great, and that's why we like EM. 10-year treasuries giving you a negative real return, corporate bonds a negative real return, and then alternatives. So that's private equity, venture capital, hedge funds, real estate, giving you 6.6% nominal or 2.6% real. So that's one of their best expected returns. Of course, that is gross. And as we all know, hedge funds and the like aren't shy on fees. So on a net basis, that's probably not going to be as exciting as you'd like. And certainly then, one of your best asset classes is emerging markets. Of course, you can look at the right-hand column there, 5% portfolio weight. So there's a lot of volatility, and BCA, being very much a US-focused research house, or Canadian-based, are concerned about the volatility, and they give us more allocation. We as South Africans, we're used to volatility, we're prepared to take on a bit more volatility to get returns. Bottom line is, unfortunately, equities are still the best place to be. But equities are going to have more volatility in the past. And unfortunately, you're going to have more equities. So you have to take on more risk to try and get even close to the real returns you used to get. So yes, more equities, even more volatility. So you've got to be able to weather that storm. Again, it talks to our glide path. So if you are gliding down from a high equity portfolio, you need more equities. But if you're gliding down to retirement and you want cash to retirement, instead of starting 5 years before retirement, you need to start before, maybe 7 or 8 years before retirement, in terms of that glide path, because there is going to be a lot more volatility and a lot lower returns. And that's key. If your markets are going up in a strong bull trend and they fall 10%, well, you can actually still have on a 1-year basis positive returns. But if they're moving sideways and you have 10% drop, well, that's the 10% drop. So lower trend growth, high volatility, it's not a pretty place to be. And that's why in this world, we like, in terms of this space, instead of alternatives, we like our thematic growth satellites. So that they're low cost, but they're also based in markets that will grow market share. So even though the world is slowing and is facing a geopolitical roadmap, disruptive technologies like 4th and our new sustainable tech fund, they are investing in companies that are creating their own market share and stealing market share from dying companies. And that's the place to be. I mean, dying companies they're zombie companies. They're not disappearing because interest rates are so low, but they are value traps. And if you can focus on growth companies, particularly companies that are growing in the right industries. So we don't want to pick growth companies just because they're expensive, which is how growth works. If you buy a growth sector or growth ETF, it looks at everything that's expensive and buys those because they have strong growth. This focuses on industries that are going to benefit from new technologies, and that's certainly why we like Fourth Industrial Revolution, and we overweight that. Fourth R has had a good return this year. I think it's up 13% in rands or 40% in rands. Not as good as other sectors, and that's why we've kept our overweight small. But we are getting to the point where we think we could be increasing that. Not yet, but we are looking at increasing that soon. So watch that space. Our biggest overweight is emerging Asia, as I said before. China and Asia they will benefit over the next decade from that next billion people becoming middle class. 88% of the next billion people becoming middle class will be in the Asia region. So that is going to grow. That consumer spend is going to grow despite Japanification. Health innovations, whether it's COVID or cancer or disease, or something that is going to be with us forever. Unfortunately, populations are aging. Populations are becoming wealthier, all of which are tailwinds for health spend, and we do think that this is a great place to be. Value is a short term, maybe the next 6 months, maybe a little bit longer, depending on how quickly it takes for US rates to rise. But we do think that the value is a good place to be in as we do forecast growth to continue, and global real estate as alternative to bonds. We still have no global bonds. Global bonds haven't done well this year. In rand terms, negative returns, and same as gold, negative returns in rands this year. So we've done well by being out of the asset classes, and continue to believe that it's not time to have exposure to those asset classes. When US yields rise, depending how much they rise, there could be a time to buy developed market bonds again. But we'll be watching that to see what happens. All depends on how much tapering and US rate increases actually impact the yield curve. So that's something that we watch. But bottom line, growth over the next decade is still going to be tough. We think 2022 is going to be a much more tough year. Growth is close to trend growth next year compared to great tailwinds for the last 2 years as we come out of the COVID recession. But not time to get out of equities yet. There's still enough tailwinds, even though they're smaller, to support returns and keep us bullish, even in a low growth, low return environment. And that is a wrap for today. So yes, there will be a webinar on China next year, and there will be a webinar on our global funds as well next year, our dollar-based funds. But this is the last Sygnia webinar for 2022. So I hope everybody has a fantastic end of year break. But I'm not going anywhere yet. Don't stress. First, I will bore you with some answers to some of the questions that come through for those of you who want to stay and get some of those answers. So Mark has a question on thematic satellites. Mark, yes, we had a webinar on them about a year ago. So if you go to our YouTube channel, you should be able to find that webinar that gives you more details on health innovation, fourth industrial revolution, and emerging markets. We will be having another webinar on that early next year, just a refresher, going into our tax close season, just so that people know, where you want to put your tax-free savings in and where best to save ahead of that tax close. But you should be able to find that on our YouTube channel, just in terms of more details. But I'm happy if you want to stick any direct questions onto Q&A. I'm happy to answer them now. Mark has a question on foreign currency limitations for Sygnia living annuity products. Mike, please email me directly, or email Cher. She'll pass it on to me, and I'll make sure that the retail team gets in touch with you to know exactly what is possible and what's not possible with your investment. Tom asked about our new sustainable tech fund. No, unfortunately, it hasn't been launched yet. We have had JSE approval, but as I've mentioned before, the JSE approval takes time. So we are looking for the next fund to be launched. So China was launched in November. Our next fund to be launched will be the China ETF in February next year, most likely. And then probably April next year, we'll be launching the Sustainable Tech ETF in South Africa, and both the China and Sustainable Tech trusts in Ireland, the dollar-based version. So that's estimated timeline right now: February for China ETF and April for Sustainable Tech unit trust and unit trust in Ireland, UCITS in Ireland, and ETF in South Africa, as well as the China UCITS in Ireland. So that's your timeline, and we will have more webinars about all of those next year. Cameron asked a question about land expropriation. Yes, I was quite surprised the ANC didn't get closer to the EFF in terms of getting sufficient support to get that bill through. But if you look at what's happened with some of the coalitions, quite surprising that the EFF has sided or joined with the DA and some of them, not the ANC. So I'm not sure about the politics that's sitting behind that, and it certainly is a risk that the EFF joins the ANC. But right now, it looks like that's not happening, and hopefully that's a result of EFF being focused on service delivery, and whether that's Eskom or all the other things that are falling apart, I don't know. But yes, a risk, one that's hopefully not happening anytime too soon. Dave mentions that you can add the post office to the growing list of SME failures. Thanks, Dave. Yes, it's a long and growing list, and very sad. Hopefully we soon get to the point where there's enough support within the ANC to stamp out corruption aggressively and allow things to start moving forward. But until that happens, we remain underweight South African equities. Still our largest asset, still our largest allocation. So on our best investment view, if you are 20 years from retirement, or even 10 years from retirement, you're in our skeleton balance 70 fund or signature 660 fund. The biggest allocation there is still the South African equities, and that's important. Of course, 70% of the revenue in some of these indices is globally based, so we are relatively cushioned against South African specific issues, which is good. What is quite surprising, the largest weight in the Aussie 40, so we have an Aussie 40 or top 40 ETF, unit trust. The largest weight in that fund is Richmond at 16%. It caught me by surprise. I thought it was Billiton and Anglos, but it's Richmond, then Billiton, then Anglos, and then Naspers is fourth. Obviously, Naspers is largest in the Swix 40, where they have your down weighting in the other ones. So right now, in terms of Sygnia funds, Duncan, we have currently we only have our China unit trust and our emerging market 50 ETF. So those are the only two vehicles you can currently get exposure. Obviously, we have exposure to those and other EM and China vehicles in our balance funds, all our balanced funds. But until we launch our China UCITS fund and our China ETF, that will be your EM50 ETF and China unit trust are our only vehicles at the moment. The TER, EJ asked about the TER on the China ETF. I stand to be corrected, but I think we're targeting a TER of 50 basis points on that. It might be 40 or 50, but that's an all-in cost of, I think, 50 basis points on that, the China ETF. As for the China unit trust, the China unit trust has the same pricing as our other thematic unit trusts. So Fourth Industrial Revolution, FANG, Health Innovation, and China unit trusts all have exactly the same fee scale. So it's nice and simple. If you want exposure to any of those thematic unit trusts, they all have the same fee scale. A class with performance fees, B class with no performance fees, which are used for the tax-free savings accounts, because you can't have performance fee in a tax-free savings account. Kamish has a great question on the opinion of the Chinese EV business NIO. At one point, it was the largest holding in our Fourth Industrial Revolution Fund. It is a much smaller allocation now. And it was trading on a ridiculous PE. It made Tesla look cheap, which is saying something. I don't unfortunately have a view. We've still got exposure to it. Obviously EVs are a thematic play, but it is a very small exposure, and I think you have to balance valuation with thematic growth. And yes, there's going to be a lot of growth coming through there, but I'm quite comfortable having a very small exposure to that in our funds. But I'm not a stock picker at all. So please don't listen to my view on NEO at all. It might be the best returning stock to be in for 2022. John has a good point that a lot of the big Goliath companies that are based in the US and Europe are global nationals, and they sell into China. And that is very true. I mean, Richemont is 16% of top 40, not because it's a South African company, but because they're selling primarily into Asia and China and doing very well. So yes, you don't have to get exposure directly through investing in China. You can get exposure to multinationals who have good China exposure. So Anheuser-Busch, British American Tobacco, Richemont, Naspers, all great South African listed global companies with EM focus, and in particular a liking to China. Obviously, every company in the world wants exposure to the strongest growth market in the world. They all want exposure to the 88% of the next billion consumer, and so they are all focusing on China. And so yes, John, I do agree with you that there is probably a lot more EM that exists in the US and Europe DM indices, just indirectly through some of those companies. But that is also, there are still a lot of constraints on what foreigners are allowed to buy in China, what they can't buy, and you do definitely get exposure to different industries and technologies. And there are, I mean, there's some companies that foreigners aren't allowed to buy because of the government's focus on those industries. So certainly by buying directly into China, you do get a bit more diversification than holding Euro Stoxx 50 or S&P 500. But very good point. The China unit trust will be in the tax-free savings account, yes, and the class B. And the ETF should be as well when it's launched. Dave asks why he hasn't been told about our dollar funds. It's breaking news. We only got, so we launched them beginning of November, but we had to apply for approval to tell South Africans about them. And that was only received last week. So this is breaking news. I don't think there have been any tweets. I don't think there's been any news about our dollar funds. It was mentioned at our results. We have had, results came out yesterday. For those of you who missed the webinar, a fantastic set of results from Sygnia. Most importantly, AUM continues to grow. We're over the 300 billion AUMA number. That's despite a lot of our competitors seeing shrinking net flows, and that's very much talking to the move towards low cost and passive. So the rest of the world is seeing a continued strong movement towards passive, low cost, thematic, systematic strategies. Sygnia is still benefiting from that. Our clients are benefiting from that, and that is again being shown by your support. So thank you for all of those who continue to invest in our funds and the AUMA growth over 300 billion now. But sorry, the dollar funds, that is breaking news. So just to repeat it, as of a few days ago, we now have approval to sell our $3 funds. It's basically a dollar cash fund. But it's slightly longer. It's about, we target about just over 2 years in duration. So it's really an income fund. It's going to give you cash plus maybe dollar cash plus 0.5% to 1%, just so you're not getting nothing, with a focus on green instruments. So very much a environmentally focused cash plus fund. For those of you who want dollar exposure, it's giving you a little bit more than dollars with a nice ESG focus. You just want to be want risk off dollars. If you want 100% equity exposure, well then you've got the two other funds that you can blend that with, or blend the cash with. So there's our Health Innovation Fund. That's an exact replica of our South Africa Unit Trust Health Innovation, and that is dollar-based. And then we have a dollar-based version of our Fourth Industrial Revolution Fund. So you can get exposure to both of those through the US unit trusts. I'm sorry, the dollar-based unit trusts. And then we have already applied to launch our China fund in that range, and sustainable tech fund in that range, but it'll probably be a 3 to 4 month process, and that's why we're estimating around April that those other two funds will be available. But then we'll have a nice suite of dollar cash, and then thematic growth equities, China, health innovation, sustainable technology, and fourth industrial revolution. And you can blend those four depending on which themes you like, and blend it with cash depending on the risk that you are prepared to take. And those are all available for a very competitive fee as well compared to active funds. So yeah, that is exciting. Bobby asked if I predict a stock market crash in 2022. I certainly don't. We are definitely getting towards the end of the cycle. I'm not going to disagree, but right now the Fed is not going to push the world into recession in 2022 unless Omicron turns out to be far worse than expected. A recession is highly unlikely on that basis. I think that's for all our questions. There should be more information on our website about our dollar-based funds soon. As I said, it is breaking news, so I don't think the fact sheets have been uploaded just yet, but they should be uploaded soon, and we'll keep you posted on what happens over the festive season until we have a formal launch next year. But that's it from me. So thank you very much for dialing in and listening. Thank you very much for your questions and your support. Please, if you have any questions or you have any suggestions about the webinar, send an email through to Sher. Her email address is on the invitation, and let me know. I really enjoy your feedback. So please do. Otherwise, have a great break, and I wish you all the best for 2022, and I'll see you next year. Keep well.